$1.5 trillion. That is the size of a single trade now sitting inside the US Treasury market, held by a small group of hedge funds, financed almost entirely with borrowed money. According to Morgan Stanley research published in January, that figure represents what's called the Treasury basis trade. According to the Chicago Fed's own estimate from March, it's at least $1 trillion. According to Apollo's chief economist Torsten Slok, hedge funds now own a record 8% of all outstanding US Treasuries, the highest share ever recorded. That number should stop you. Because the last time hedge funds held this kind of leveraged position in the world's safest bond market, the entire system seized up. It was March 2020. The Federal Reserve had to step in with the largest emergency intervention in central bank history to stop the unwind. And here's what's strange about today. The position is now bigger than it was then. Tomorrow morning, the US Treasury announces its quarterly refunding plan, the schedule for how it will fund a $1.9 trillion deficit over the coming months. And almost nobody is talking about the trade quietly sitting underneath that market waiting. This is the story of how the plumbing of American debt got dependent on a single arbitrage strategy. Why regulators have been warning about it for 2 years and done nothing. And why, if you have a mortgage, a 401k, or a savings account in dollars, you have a stake in how this resolves, whether you've ever heard the words basis trade or not. Let's start with what this matters for in your daily life. Because before we get into the mechanics, you need to understand the stakes. The Treasury market is the single most important market on earth. Every mortgage rate in America is priced off the 10-year Treasury yield. Every car loan, every credit card, every student loan, every corporate bond, they all anchor to Treasury yields. When that anchor moves violently, your borrowing costs move with it. When that anchor breaks, the cost of everything you finance changes overnight. In March 2020, for about 10 days, the Treasury market stopped functioning normally. The bid-ask spreads on supposedly the safest bonds in the world widened to levels we usually only see in emerging market crises. Mortgage rates spiked even as the Fed was cutting overnight rates to zero. Why? Because hedge funds running a leveraged Treasury arbitrage trade got margin called all at once and had to dump bonds into a market that nobody wanted to buy. The Fed ended up purchasing roughly $1 trillion in Treasuries in a matter of weeks just to put a floor under the market. That intervention worked, but it left a lesson, and apparently a habit. So what is the basis trade actually doing? Stay with me because the mechanics matter, but they're not as complicated as the name suggests. Picture two nearly identical things, the same Treasury bond but in two different markets. One version is the actual cash bond traded in the spot market. The other version is a futures contract traded on the Chicago Mercantile Exchange that promises delivery of essentially the same bond in 3 months. Because they're nearly identical, their prices move almost in lockstep. But they're not perfectly identical. There's usually a tiny price gap between them, a few basis points, sometimes less. A basis point is 1/100%. We're talking about pennies on $100. Hedge funds noticed this gap, and they figured out a strategy. Buy the cash bond, sell the futures contract, hold both until they converge, and pocket the spread. The trade itself earns almost nothing. Maybe 10 basis points a year, maybe less. It's the financial equivalent of picking up dimes off the sidewalk. But here's the part that matters. Hedge funds don't put up much of their own money to do this. They borrow against the cash treasury they bought in the repo market at leverage ratios that can run 50-to-1 or even 100-to-1. So that 10 basis point return on a tiny sliver of equity becomes a much larger return on the actual cash they put down. The Bank for International Settlements estimated leverage in this trade can hit 70-to-1 in some cases, which means a 1% adverse move can wipe out the entire position. That's the trade. Buy cash, short futures, leverage up enormously, harvest the tiny spread, repeat. And the position has now grown, depending on whose estimate you trust, to somewhere between $1 trillion and $1.5 trillion. This brings us to pillar one. Why has it grown so big so fast? The honest answer is that the US Treasury keeps issuing more debt than the natural buyers of that debt want to absorb. Foreign central banks used to soak up huge amounts of treasuries. China and Hong Kong combined have shed roughly $96 billion over the past 12 months, according to the most recent Treasury International Capital data through February. Japan, the largest foreign holder, just spent roughly $34.5 billion on May 1st defending the yen, money that came partly out of its dollar reserves. The traditional foreign demand pillar has cracked. Domestic banks also stepped back. After the 2023 regional bank failures, banks became reluctant to hold long-duration treasuries because the price losses can hit their capital. The Fed and other regulators tried to fix this last November by finalizing changes to bank capital rules, a tweak to something called the supplementary leverage ratio. The goal was to make it cheaper for banks to hold treasuries. The effect so far has been modest, so who's left to buy? Increasingly, hedge funds running the basis trade. Through the structure of how that trade works, they end up buying treasuries with borrowed money and effectively becoming a major source of demand at auction. That sounds helpful until you realize what it actually means. The largest sovereign debt market on earth is now structurally dependent on a leveraged arbitrage strategy run by maybe 24 hedge funds, financed in the repo market, with no obligation to keep showing up if conditions change. Now here's the counterargument, and it's worth taking seriously. Defenders of the trade, and there are credible ones, point out that hedge funds are providing liquidity that Treasury desperately needs. Without them, auction tails would widen, yields would rise, and the cost of financing the deficit would climb. The Federal Reserve's own staff papers acknowledge this. The basis trade isn't speculation in the casino sense. It's an arbitrage that in normal times makes the Treasury market work better. The question regulators are wrestling with is whether normal times are something we can count on. That brings us to Pillar 2, the part that should make you uncomfortable. Treasury and the Federal Reserve both know about this. They've known for years, and they have not been able to diffuse it. Here's the timeline. After the March 2020 unwind, the Federal Reserve published a detailed post-mortem. The Office of Financial Research, an arm of the Treasury, started publishing a hedge fund monitor that tracks short Treasury futures positions almost in real time. The Financial Stability Oversight Council, FSOC, flagged the basis trade as a systemic risk. Academic papers were written. Congressional Research Service reports were filed. Brookings published a paper just this March titled Treasury Market Dysfunction and the Role of the Central Bank. And in April of this year, Apollo's Torsten Slok, one of the most cited economists on Wall Street, wrote that hedge fund leverage in treasuries has reached record highs. Combined repo and prime brokerage borrowing now exceeds $6 trillion. He warned that any forced unwinding could trigger sharp moves in bond prices and create wider instability. 5 years of warnings. The trade is bigger now than it was when it broke the market the first time. Why? Because every actor in the system has reasons to keep it going. Treasury needs the liquidity. The hedge funds earn their fees. Primary dealers earn their spreads. The Fed doesn't want to crack down because the alternative is auction failures. So everyone watches the dial creep into the red and tells themselves it's fine until it isn't. Pause on that for a moment, because if you're sitting at home wondering how this connects to your life, here's the link. When this trade unwinds, and at some point all leverage trades unwind, Treasury yields spike. When Treasury yields spike, mortgage rates spike. The 30-year fixed mortgage moves almost in lockstep with the 10-year Treasury, which closed last week at 4.45%. If yields jump 100 basis points in a panic, your refinancing window closes. Your home equity line gets repriced, your variable rate debt gets more expensive. The pension fund holding your retirement savings takes mark-to-market losses on its bond portfolio. The companies you work for and buy from face higher borrowing costs that get passed through as higher prices. This is not abstract. This is the transmission belt that runs from a hedge fund's leveraged book through the Treasury market into your kitchen. Which brings us to tomorrow, May 6th. The Treasury quarterly refunding announcement. Treasury announced on May 1st that it expects to borrow $109 billion in privately held net marketable debt this quarter, assuming an end-of-June cash balance of $850 billion. According to Reuters' May 1st preview, dealers expect coupon sizes, the amount Treasury sells of 3-year, 10-year, and 30-year notes and bonds, to remain unchanged for the 8th straight quarter. They expect Treasury to lean increasingly on Treasury bills, the shortest duration debt, to fund the deficit. That sounds boring. It is not boring. Here's why. When Treasury holds coupon sizes flat in the face of growing borrowing needs, every additional dollar of deficit gets pushed into bills. Bills now make up roughly 22% of marketable debt, a level Treasury's own borrowing advisory committee has said is uncomfortably high. That short duration bias makes the entire debt stock more sensitive to interest rate moves. Every time the Fed adjusts rates, the cost of refinancing that bill stock changes almost immediately. The interest expense on the federal debt has already hit $623 billion in fiscal year 2026 to date, according to Treasury fiscal data, with the average rate on marketable debt at 3.355%. The Congressional Budget Office projects net interest costs will more than double from $970 billion to over $2 trillion by the next decade. So tomorrow's announcement isn't just a calendar item. It's a referendum on whether Treasury's debt management strategy is sustainable. The reason coupon sizes haven't been raised by most analyst readings is because there isn't enough natural demand to absorb bigger long-duration auctions without yields backing up sharply. That's the same demand vacuum the basis trade has been quietly filling. Pillar 3. What does an unwind actually look like? And what should you watch? 3 signals matter. The first is auction quality. Pay attention to 2 technical metrics: bid-to-cover ratios and tails. Bid to cover tells you how much demand showed up relative to what was sold. A healthy 10-year auction runs around 2.5 times. A tail tells you whether the auction priced at a higher yield than the market expected just before, a sign of weakness. The April 30-year auction tailed by half a basis point and ran a bid to cover of 2.39, slightly below the recent average. That's not a crisis. It is a yellow light. The second signal is repo market stress. The basis trade lives or dies in the repo market, where hedge funds borrow against their Treasury holdings overnight. When repo rates spike above the Fed's reverse repo rate, it means the system is short of cash. The Treasury repo market is roughly $8.8 trillion. Sudden moves there in 2019 and again in 2020 preceded broader Treasury dysfunction. The third signal is hedge fund net short futures positions. The Office of Financial Research publishes this data weekly. Watch for any sharp drop. A sudden decrease in short futures positions doesn't mean the trade has been peacefully dismantled. It usually means traders got margin called and forced out. If those three signals start moving the wrong way at the same time, history suggests the Federal Reserve will have to step in again, exactly as it did in March 2020. The mechanism for that intervention is the standing repo facility set up in 2021 specifically to prevent another basis trade panic. Whether it's large enough to handle a $1.5 trillion position is the open question. The Federal Reserve's own staff has acknowledged in published research that in a true panic, the existing facilities may not be sufficient, meaning the Fed would have to expand its balance sheet, which currently holds about $4.4 trillion in treasuries, by hundreds of billions more. That's where the political dimension enters, and we have to be careful here, because the Federal Reserve's chairmanship is changing on May 15th. Powell's term ends. Kevin Warsh, the nominee, is expected to face a Senate floor vote the week of May 11th. Whatever you think of either man, the institutional question is this. A chair transition during a refunding cycle, with a hedge fund position this size sitting in the market, is the kind of timing that historically breeds policy mistakes. The strongest defense of the current handover process is that the Fed's institutional independence, its staff, its committee, its tools, survives any single chair change. That's a real argument. But it's also true that markets price credibility, and credibility transitions are rarely smooth in stressed conditions. Here's the synthesis. We started with a number in $1.5 trillion, and that should stop you. We've now built out why. A Treasury market that issues more debt than its natural buyers want to absorb. A hedge fund strategy that fills the gap with leverage. Regulators who've been warning for 5 years and watching the position grow anyway. A refunding announcement tomorrow that will likely confirm Treasury's growing dependence on bill issuance and by extension on the basis trade. And a Fed chair handover happening in 9 days. The range to watch over the next quarter is wide. If conditions stay calm, the trade keeps quietly working, Treasury issues, hedge funds absorb, yields stay anchored, your mortgage rate doesn't move much, that's the baseline scenario most analysts still hold. If repo stress combines with a tariff shock or a geopolitical jolt, and remember, Brent crude is above $110 with the Strait of Hormuz still partially closed, the position becomes the system's largest single point of failure. Analysts are watching the next 90 days closely. What you can do as a viewer is not panic. Panic is for people who didn't see it coming. You're seeing it. The Federal Reserve sees it. Apollo sees it. The Chicago Fed sees it. The most useful posture is informed patience, understanding that the plumbing of American sovereign debt is more fragile than the headline numbers suggest, and that household financial decisions made in the next few months should account for higher rate volatility than usual, not the calm averages of the last decade. One thing history makes clear. Markets that depend on a single concentrated trade always end up testing it. The only question is when and how violently. The answer to that arrives one auction at a time, one refunding cycle at a time, until it doesn't. If this breakdown helped you understand what's actually moving inside the Treasury market, the bell icon makes sure you catch the next one. We're tracking the May 6th refunding announcement and what the Fed chair transition means for debt management. See you there.